Happy New Year, guys. Welcome back to AK Trades. In this channel, I aim to help you trash out the numerous trading concepts out there to arrive at a simple and profitable strategy grounded in the teachings of the inner circle trader. If you are a beginner trader overwhelmed by different models and concepts, look no further because you are in the right place. I'm Augustine and I bring you the best trading insights at a zero cost. If you appreciate my efforts, please like this video and subscribe to the channel for weekly updates. In my previous lesson, I covered the weekly profile and how I use it to anticipate the bias of the week using daily PD arrays. In today's lesson, what I seek to cover in my trading strategy is interbank price delivery algorithm, that is IPDA cycle, and how to use the candle range theory to anticipate reversals of PD arrays, specifically on the 4-hour charts. Now, what is IPDA? The IPDA cycle provides traders the insights as to where the banks and bigger institutions intend to send price. Now, this knowledge helps traders to plan and align themselves to trade in tandem with the market makers. This equally affects which key level to enter or exit your positions. Now, when we talk about the IPDA cycle, it comes with 4 phases of price delivery, and these are consolidation, from consolidation to expansion, from expansion to retracement, and from retracement to reversals. Now, price can also move from a reversal to retracement, from a retracement to expansion, and from expansion to consolidation. The same way, price can also retrace and enter into a consolidation phase. But what price do not do is to move from consolidation back into a reversal. Now, this is what will lead us into ICT's power of 3, or AMD, that is accumulation, manipulation, and distribution. Now, when we consider a bearish market, price expanded from a bearish PD area on a higher time frame, entered into a consolidation phase, and then look at what happened at this point. Price seemed to be reversing to the opposite direction. But normally, when price does this, it is only to trick inexperienced traders to trade the opposite side of the market. Now, why am I saying this? Beginner IC traders, when you go through the ICT 2022 mentorship, now what he teaches there is about what? Market reversals using market strata shifts with displacements, right? Okay, now on a higher time frame, for example, on a 4-hour time frame, this will seem like a week. This will be a week. But when you drop down to the lower time frames, that is from the 15 and below, this is how actually the markets will behave. Now, this is your market structure shifts, and then inexperienced traders immediately they see this, they are like, oh, that is it, 2022 model, market structure shift is there, my displacement or fair value gap is there, so boom, that is it. But in most of the cases, this is just a manipulation to trick you into going bullish, even though the market is bearish. Now, they will place their positions here, they will enter the trades here, and before they realize, the market will just drive through their stop loss. And they are like, oh, ICT concept does not work. ICT is a fraud and all those kind of comments on social media. But that is not actually the case. It is you who is not trading the concepts in the right way. It is you that is not trading the concepts in the right way. So it is important to know each of the phases of the market. Now, when you have this concept of the IPDA cycle in mind, it will help you to escape such manipulations. It will help you escape such manipulations so that you trade at a safer side of the market. Now, this is mostly everything about IPDA cycle. Like I said, all I do is to simplify all the concepts out there into a simple strategy. I explain everything in the simplest way you can get. Now, let's move on to our CRT and reversals. What is CRT? That is the candle range theory. Now, the candle range theory makes us understand that every candle is a range. Now, when that range is high or low is rated by the next candle and closed within, we anticipate price to reverse to the opposite side of the previous candle's low or high. So this is our candle one, also our range. Now, when you look on the chart, you realize that candle one tapped into a 4-hour or any higher time frame key level. Now look at what candle 2 did. Candle 2 opened very close to candle 1's closure and then raided the previous candle's high and closed back within it. Now this is an expansion into a reversal phase. Remember, always have IPDA market cycle in your mind. Now this is an expansion and then reversal. So what we seek to do is to trade this reversal or expansion candle. This is what we are targeting. So when you look at these points, I've placed some icons to depict the targets we are trading. Now, I am not interested in this candle because I'm in a bearish market. What I'm interested in is this expansion or reversal to my 4-hour external range liquidity or old low. Now, let's look at another scenario. In this scenario, the same way expansion into a reversal. The bearish expansion candle failed to read the high of the previous candle. Now, normally this happens when candle 1 printed a reversal signature on the lower time frame. So you realize that when you drop down to the 15-minute chart, there will be a market structure shift or change in state delivery printed by this candle 1. So when candle 2 opens, all it needs to do is to form its high within the reversal signature of the previous candle. So it opens, taps into the change in state delivery or market structure shift with displacement, and then what descends lower to our 4-hour external range liquidity. Now let's move on to scenario 2. In scenario 2, what we have here is an expansion into a consolidation phase and then expansion lower. Now, what is happening here is a 3-candle formation. Candle 1 tapped into a 4-hour key level. Look at what candle 2 did. Consolidated and manipulated. This is our manipulation leg. It manipulated the previous candle high. But the difference between scenario 1 and scenario 2 is that The same candle that formed the reversal candle, this is our reversal candle, telling us that the market is now ready to go lower to a 4-hour external range liquidity. This same candle was not the candle that expanded. It printed the reversal signature, but because the market was still in a consolidation phase, it failed to expand. Now, we are not also interested in this candle. We are interested in trading this expansion candle into our 4-hour external range liquidity. So the same way the 4-hour expansion candle opens, the high taps into a key level within the reversal candle and then descends lower to our 4-hour external range liquidity. Now, the similar scenario, the consolidation candle here in this scenario failed to manipulate candle 1's high, but rather formed an inside bar. Now, in this case, you realize that on the lower time frame, that is on our 15-minute chart, there will be no reversal signature or confirmation on the 15-minute chart. There will not be any market structure shifts or change in state of delivery. Now, when this happens, all you need to do is to wait patiently for candle 3's open. Now it opened and then rated both candle 1 and candle 2's high and then closed within the range, that is candle 1's range. Now this is what we are looking to trade. Price reverse into our 4-hour external range liquidity. Now these reversal signatures or the CRT reversal signatures can also help us to identify our swing points, in the sense that when you hop onto the chart, now this CRT reversal signature can be applied on all time frames. It is fractal, it occurs on all time frames. But with my strategy, I use it more on my higher time frames. That is my weekly, my daily, and also my 4-hour. Now, on my 4-hour time frame, remember, as I always talk about, dealing ranges are very important. Identifying the current dealing range is very significant. So the CRT reversal signature can also help you identify the swing points to mark out your dealing range highs and then lows. So when you look at this scenario, this point will be our dealing range high and our 4-hour external range liquidity, or candle 1's low will be our dealing range low. The same things apply at this point and all the other points. So wherever you see these kind of reversal signatures being printed, then you are very certain that those areas will be your swing points. So as we discussed in my trading strategy overview, I trade the 4-hour market maker model. So when we move on to our 4-hour market maker model, these are the areas that I look to anticipate the CRT reversal signatures. So when we come to the 4-hour chart, you see price expanded lower, retraced into our change in state of delivery, that is our low risk sell. So at this point, when price taps into our change in state of delivery, I'm looking forward for the reversal signature to be printed here so that I can trade to my 4-hour external range liquidity. The same thing will happen at the first stage distribution and then the second stage distribution, or ICT's silver bullet. So let's hop into the charts and look at some chart examples to get a clear picture of what I am trying to communicate. Now, on the 4-hour chart, look at what's happening here. This candle rated these highs, these swing points, and look at what happened. Before that, price expanded lower. This is our manipulation, and then it's retraced. So we have an expansion, retracement, and from the retracement, we entered into a consolidation phase. Now, from the consolidation phase, as I stated, came our manipulation. Now, let's drop to the 15-minute chart and see what happened with this manipulation. On the 15-minute charts, let's see what happened with this manipulation. You see, this is exactly what I was talking about. There will be a market structure shift, and then inexperienced traders will identify this as their displacement, that is their fair value gap, in order to position themselves. Exactly what I was talking about. So they place their setups here and look to target these highs. But look at what happens then. Straight up, they are just run over by the market. And as I said, most people will complain ICT is a fraud, this concept does not work. But actually, he is not the problem. You are the one not treating the concepts in the right way. So you see, these things happen all the time in the market. Now look at this point. When price retraced after expansion, retraced into a 4-hour internal range liquidity. Look at what happened. Candle 1 tapped into the 4-hour internal range liquidity, and then candle 2 failed to read the previous candle's high. Why is that? Because here there was a reversal signature that had been printed here. So there was no need for the market to further manipulate the previous candle's high before going lower. So that is basically what happens in the market with candle range theory and then reversals. So I thank each and every one of you for being patient and staying with me, coming onto the channel every week to watch my videos. So I may not be able to cover everything that probably you are expecting. There are things that I might probably forget to bring out. If you have any question or anything that bothers your mind, feel free to add it to the comment section below so that in my subsequent videos I address all those questions. Thank you very much for being with me today. Stay tuned for our weekly updates